Hi, in last calendar year, Nifty 50 gave about 10.1% returns. Whereas I've just picked two random funds. One is HDFC's Nifty 50 index fund, which gave about 9.9%, whereas another fund by Taurus gave about 8.8%. So a good 1.3% below the Nifty 50 index. Now we might think all index funds are equal. So how one specific fund has been able to closely replicate what index is giving, whereas another fund has about 1.3% difference, which is substantial for an index fund. So in today's video, we're going to learn about what these index funds are and how best to pick up these index funds. I am Vivek Sharma, Head of Investments at Good Luck. An index fund is a fund which tries to mirror the performance of an index. Now, index could be Nifty 50 or Nifty Next 50 or Nifty 500. An index fund would always have the components that are present in an index. By law, 95% of the investment should go into investments in these components, whereas 5% could be futures or other correlated instruments to reduce the tracking error. Investing in an index fund is a passive strategy where the fund manager is just trying to replicate an index and have a very low tracking error, which is the difference between the index performance and the performance of the fund. There is almost 3 lakh crore which has been invested in index funds. So it's a very popular category of funds. And it is popular because it is very simple to understand, very low cost, and everyone from novice investor to experienced investors do invest in index funds. Now, an index fund is made of basket of stocks which needs to be updated on a regular basis. So there is a process named as rebalancing, which happens twice a year, typically in March and September for Nifty 50, in which the weights of all the 50 components is readjusted back to what its weight should be as per the new updated prices. The other thing is index reconstitution, in which what happens is some of the stocks are booted out of the index which are not performing well and where the market cap has gone down, whereas other stocks which are doing well gets included in the index. Both of these happens typically around March and September, that is twice a year. For most of the index funds. For few, it could be quarterly or yearly rebalance and reconstitution as well. Now, typically this follows a very set pattern of rebalancing and reconstitution in March and September, but sometimes, like in the case of Satyam, where the fraud was detected in January 2009, and that's when the index was reconstituted and rebalanced because of that fraud. So it could happen anytime, which is quite rare. And typically it happens in March and September for most of the index funds. Now, index is actually a theoretical concept. You actually cannot invest in an index. So what these AMCs, which are asset management companies like HDFC, ICICI or Taurus, what they do is they roll out index funds in which actually investors can go ahead and invest. So these index funds, what they try to do is they try to replicate or mimic the performance of that specific index. Because they are trying to replicate, they are one step behind, and also their costs of brokerage or even slippages, due to which an index fund can't actually achieve the performance of an index exactly. There is some tracking difference, and now this, in my earlier example, I showed that HDFC's tracking difference was pretty small, whereas Taurus index fund had a tracking difference of 1.3%, which is fairly large. So this specific tracking difference, when you're trying to select an index fund, you should track this and see which are the index funds that have the lowest tracking error over longer run. Now, these index funds could be of 3 types. One could be based on purely equity, another could be based on purely on debt, and third could be hybrid, which is a mixture of both debt and equity. Although hybrid index funds are not yet released because they have just been allowed in March 25. So in the next couple of months and quarters, we are going to see a few hybrid funds also roll out in the index category. Equity funds could be of multiple types. One is broad-based equity funds, could be based on Nifty 50, Sensex, Nifty Next 50 or Nifty or BSE 500. Second type could be international, based on S&P or Nasdaq. Third could be sectoral or thematic, could be infrastructure, on real estate, on IT. And the fourth type, which is new type, which is the factor based funds, could be based on value, could be based on momentum or alpha. These factor based funds again could have universe of Nifty 50, Nifty 200 or the top 500 stocks. Next, let's look at how do we select these index funds. So for the beginner investors, I think it's pretty straightforward that you just select Nifty 50 on the basis of the factors that we are going to talk about and invest in it. It's a fairly simple and easy choice. It's only after that you have gained experience you can look at other kind of funds, like either factor based funds or funds that mimic small cap or mid cap indices. First thing that you should do is look at the historical track record. It should have a decent track record. By decent I mean at least 3 years of track record. Funds that are very new, no point investing in them just to save few basis point in fees. Funds that beat the index, typically they sound very attractive, but you should not select the funds that beat the index because it reflects poorly on how that specific index fund is being managed. Ideally, an index fund should never be able to beat the index performance. It should always be slightly lower because of the things that I talked about earlier, which is the costs of transaction, could be brokerages, could be slippages and other costs. One thing that we have done is we have given an Excel file which we got from Amphi's website and made some changes. You can also go to Amphi's website and download the raw Excel file and track matrices like the tracking error. Now let's look at some of the problems with these index funds. One of the problem which is quoted fairly commonly is that of a free rider problem, which means that people say that the managers of these index funds, they rely on other active managers, that they will do their job well and research and monitor the governance issues in these companies, because an index fund manager really cannot take a call even if they identify there is some governance or other kind of issues with this a specific company. They really cannot take an active call and reduce their exposure. They have to follow and allocate the specific amount of weightage that is there in the index for that specific company. Second is that of average returns. Now if you really want to beat the index, you have to go with active fund managers and not invest in a passive strategy with an index fund. Although having said that, about 25 to 30% of the active managers are able to beat the index. So even if you are investing with index funds and getting those average returns, you will be beating about 70 to 80% of all the investors out there. And the third problem is that of active risk migration, which means that if you as a fund manager feel that the markets are overly priced and you want to reduce your exposure towards equity, you cannot actually do that, because by rule you have to be 100% invested in equity markets. And again, this could be a feature as well for these index funds, because many of times these managers who take these active calls are not very good at it, right? Again, another problem is that there are no hybrid index funds as of now. So a novice investor or any even experienced investor who wants to take call and not invest 100% into equity and divide between equity and debt, as of now there are no currently options in index fund category. They have to go with active fund category for now. So the bottom line is index funds are suitable for most of the investors. It's a very simple and stress-free choice. Second point is that of active versus passive choice is not really that binary choice. You don't necessarily need to be an active or a passive investor. You can be both. Like what I personally do is I have about 60 to 70% of my overall equity investments in active funds, whereas the rest 30 to 40, which is a substantial part, in passive funds. Third is you can choose passive funds, which are these index funds, wherever the opportunity set is smaller and the markets are efficient. So in case of developed markets, or in case you want to invest primarily in large cap funds, in that case you can select passive funds. Whereas in the case you want to go ahead with mid cap, small cap or factor based funds and want to take higher risk, in that case you can actually go ahead and select active funds, because the markets in these areas are pretty inefficient. Thanks a lot for watching today's videos, and please do let us know in comments if you would like us to do this YouTube webinar or YouTube video on any other topic.